Stocks looking to end this week's big comeback on another positive note. The S&P 500 now just 2% from record highs set mid-July. And value stocks even closer to that milestone, just 1% from an all-time high set 2 weeks ago. Noted value investor Scott Black joins me now to share where he is investing. He's Delphi Management's president and founder. It's good to see you. Welcome back.
Thank you for inviting me.
We mentioned in the tease to this segment that you think the market's exhibiting some euphoria. In what sense?
Okay, if you look at the PE ratios, let's take the NASDAQ, for example. It's selling at 27 times this year's earnings. The Russell 2000 is 28 times, and based on my calculation of 235 and S&P 500 earnings, the market's about 23.5 multiple. And if you look at the concentration, the NASDAQ, the top 10 stocks are 50%, and almost 38% in the S&P. With the exception of Meta and Alphabet, every one of those other 8 out of the 10 are selling between 33 and 90 times this year's earnings. I'm not saying they're not good companies. They're excellent companies, but these are full multiples going in. And what's happened is I think people are concerned that, we're going to avoid a recession, that the Fed's suddenly going to drop, cut the rate, which I suspect they will, 25 basis points, although they haven't reached the 2% inflation target. So that's mixed in, the imminent cut. I think they like what they saw with the consumer was up 1% this year, month over month. And as I say, the headline CPI number was under 3%. The actual energy and food was 3.2. So I think there's just too much expectation already baked in. And the S&P estimates are much too high. When I did the Barron's Roundtable in July, they stood at 241. They're already down to 238. And that would imply that the back half of the year, the S&P operating earnings will be up over 18%. Hard to believe, because in the last quarter, they're up 7.1. So if you put it all together, it seems to me that markets are expensive.
Okay, well, so it says to me you're such a famed value investor who doesn't find much value in the market. So what does that mean? Are you waiting for a significant pullback you think is coming before you would deploy any capital to the stocks you have your eye on?
No, we always stay fully invested. We're about 90 to 93% invested at all time. At this juncture, we're about 92%. But at the margin, it's getting increasingly difficult to find companies that have high returns on equity, strong free cash generation, selling at low multiples. Because we like companies that aren't in a turnaround situation where you have 2 or 3 quarters of down earnings. So, the typical PE at Delphi now is about 12 times earnings, which is half the market multiple.
What's your best name right now?
Well, I sent you one. It's called SS&C Technologies in Windsor, Connecticut. It's a little fintech company. Most people don't know it, but it's about a $17 billion market cap. The stock is around $72 a share, and they're going to earn about $5.75 next year, so it's about a 12.5 PE. The company generates close to $1 billion a year in free cash. They basically have authorized another $1 billion buyback, and they're strong. With private equity and hedge funds, they're the strongest asset facilitator in terms of back office, algorithms, marking to market. They're also the largest transfer agent in the mutual fund industry. The company's not a barn burner on the top line. It grows 5 or 6%, but they've increased the operating margins. They picked up about 170 basis points in operating margin this year. And so you get operating leverage plus buyback. Instead of having 5% top line growth, that translates into about 11% bottom line. I just think it's awfully cheap at a 12 multiple or 20% return on equity.
Okay. Do you still like some of the other picks that you made for the roundtable, like
absolutely
Everest and Diamondback and stuff like that?
Absolutely. Every one of the stocks, 4 in the first session and 2 the summer session, all 6, we own all of them. Well, I want to point out, although global payments is down, they've come in with record earnings quarter after quarter. It's the old Ben Graham. In the short term, it's a voting machine. In the long term, it's a weighing machine. It's ridiculous that global payments, who's growing at roughly double digits on the bottom line, sells under a 9 PE. Each one of these companies, if you look, had an up quarter year over year, both in the first and the second quarter of the year, and they all sell at relatively low PEs, anywhere between 8 and 12 times next year's earnings.